We're back. Happy summer. Happy Friday. My name is Dan O'Weir. I'm the marketing director for Sonoma Wealth Advisors, and you have found our weekly update show, straightforward financial market updates. We call it On the Markets. I'm joined by one of our managing principals this week, Chris Sipes, CFP. We're going to talk about the tax impacts from the so-called Big Beautiful Bill, how non-U.S. companies are buying back their own stock and why, and Bitcoin experiencing a little bit of a candle moment, and also how a piece of 90s software to me says everything about what the Fed's doing and is going to do and really can't stop doing. But first, we'll do this. Chris, you used PCs in the 90s. I know you did. I know that you use a personal computer.
Yes, I am from Ohio, but we did have PCs in the 90s.
They made it out there. You had a gateway. I know it. So this week, as we were brainstorming ideas on what to do for the show, we're talking with Darren. Darren is on assignment this week, but he helped contribute to the production. Big theme this week is that the Fed cannot stop printing money. They would, even if they wanted to, at this point, they're sort of cornered. And there's a rumor this week that Chair Powell may be resigning, in which case whoever he is replaced with would perhaps be in the vein of something that might please Donald Trump. And he definitely wants rates down. That would therefore also mean probably printing up. So as we were talking through this, I just remembered this old program that we used to use in the 90s when you were going to like make your own. Remember that thing in the 90s, Chris? You'd make your own invitations, like your own birthday invitations or your own Christmas cards. Yes. The program that you would use to do that was called the Print Shop Deluxe. And it was actually a local, it was a company that at least had a presence in Marin. I don't know if they were exclusively in Marin, called Broderbund. And it was everywhere. And like, you use this nonstop. And I'm like, this is the Fed right now. Like the Fed is just literally like, just like I used to sit there and make up greeting cards and put as many Mario stickers on there as I wanted. This is what the Fed is doing with dollar bills.
Well, it's, yes, Dan, I think the analogy is stretched, but it's well taken there. And, you know, Jeff Bezos, who from Amazon is famous for saying something along the lines of like, instead of betting on what's going to be new and innovative, instead ask yourself what's not going to change, right? Invert that. That question of how can I change everything? How can I do things totally different? Invert that and say, what is going to stay the same, right? And I think that with the passage of the Big Beautiful Bill, we know that at least for the foreseeable future, there's not going to be a lot of changes in terms of the debt and deficits. And, we're probably going to continue doing what we're doing now until something happens. You know, it's been the history of not just this Fed, but and government, but not just our current time. But I think the administrations in general is that until there's a crisis, there's usually no changes, right? People generally don't collectively get the will to make a change until there's a crisis, and that's looks like what's going to happen again this time.
And it is impacting the market in a good way, but define good. So we'll look at that this week, and we'll also look at this slide. Chris, I don't know what this is. What are we talking about here? I don't know this story.
Well, we've been lacking on memes here lately, and I just thought this was funny. This was posted from Jan Van Eck at the Van Eck Funds, and he's like, it's the cover of the New York Post. And it says, man wins $4.5 million per toe he lost in a subway train. And you foot the bill. And it's got piggy bank.
Oh, my God.
As a big fan of dad jokes, I felt like
Yeah.
this whole cover is just one big dad joke. Like
Yes. Yes.
whoever came up with that must have had tongue firmly in cheek. And
The New York Post has trained its chat GPT to know dad jokes. I appreciate that.
yeah, yeah. Now, on a little more serious note, we say this all the time. I never really knew who to attribute it to, but it looks like it was Peter Bernstein. And that quote is, "The only time you're really diversified is when you have assets you don't want to own." Right? We talk about that where, if you look at your portfolio and everything is exactly what you want in terms of it's going up, right? We all want that. We always want the portfolio to be going up. But if they're all going up at the same time, that likely means they're all going to go down at the same time. And maybe that's the way you have your portfolio calibrated, and that's fine. But just know that's likely what's going to happen. Whereas the benefits of diversification are that it protects your risk. Usually you give up a little bit in terms of growth relative to whatever the hottest performing asset class is, but you gain a lot in terms of risk control. And you have some things that zig when other things zag. And so if you look at your portfolio, if you're properly diversified, you're probably going to zero in on at least a few things where you're not super thrilled to have in the portfolio.
Chris, you've been doing this long enough, and Peter Bernstein, by the way, is a famous economist. You've been doing this long enough, and you've had clients who've been with you long enough. Have you seen the things in their portfolio, the thing in your portfolio that, quote, sucks? Have you ever seen it flip, and then you say, hey, see?
Yeah, I think at least this year so far, the best example of that would be foreign stocks.
Yeah, I was going to say Europe.
Lagged. Yep, for years have lagged and just kind of done nothing, and then this year just kind of out of nowhere. And I can tell you that no one was guessing that was what was going to happen in the fall of last year. There were zero people expecting outperformance from foreign stocks this year, and that's professionals and lay people.
Just a quick note. So as I mentioned, I'm Dan O'Weir. I'm the marketing director for our firm, Sonoma Wealth. Chris is one of the managing principals, as is Darren. Our whole firm, collectively, we have a family of brands, including a 401k brand from out of 401k, tax branch from out of tax. We have over 900 million under management, and we host the show weekly. And we look across various indicators and pieces of data that we feel might either be of interest or affect the market. And this one, Chris, I slightly smile at this one, and I laugh a little bit at the top 15 military budgets in 2025. It makes me chuckle.
Why is that, Dano?
Well, you just explain what we're looking at here, and I'll tell you why I think it's funny.
So first off, this is from a website called Visual Capitalist. There's tons of cool, like if you're into visualizing financials, this place is like a treasure trove that you can check out. And they've got all kinds of cool graphics. And this one is showing the U.S. military budget in 2025 looks to be $962 billion versus, they've got China, Russia, Germany, UK, India, Saudi Arabia, Japan, Ukraine, France, South Korea, Italy, Israel, Poland, and Australia. All of those countries combined spend just slightly more than we do here in the U.S. on military budgets. And the point of putting this in there was that when you look at debt and deficits, nobody wants to cut the things that would actually make a difference in that debt and deficit. And when I mean nobody, I'm talking about the politicians for sure, and even and the politicians, I guess, are just executing what the people want, right? We all say we want a balanced budget. We don't want to go into debt, et cetera, et cetera. But when it comes time to start cutting, of course, none of us really want our thing cut. And that applies to everybody, right? And so, but in order to make any sort of difference in this situation, we would need to cut some things. One of them would have to be military budgets. Now, that's obviously, there's pros and cons to that. right? I'm not smart enough to know what all the fallout of that would be, but making little changes around the edges is not going to make the impact that we need.
I think why it makes me laugh is a lot of number one, a lot of people like to, it's widely considered, widely agreed upon that the United States is, quote, the number one country or the country of focus or whatever you want to say, whatever you want to call it. That's irrelevant, by the way, to who cares. But a lot of people consider that, a lot of people consider, the Beatles weren't a band until they came to America, whatever. So then it becomes a case of like, well, why? And it like people will say like, oh, it's our movies, or they'll say, well, Wall Street's here, or they'll say it's some of the best restaurants in the world, whatever it may be. But you just look at how big that number is.
Yeah, well,
it's just like it would be like if you're just like, hey USA, what are you up to? And like you pull behind the curtain and we're just like bombs, huh? What? I mean, it's just like it's just it's like nobody, nobody. They're just like sitting there enjoying a beautiful Swiss day on a July Saturday, and it's like you cut to the United States, and you're like, okay, how can we make an invisible aircraft carrier when there isn't even a war actually happening? It just makes me laugh.
And it does relate back to finances in this way, and that is that historically the country with the biggest defense, namely the biggest, most powerful navy, has been the reserve currency. And so in some ways, I think you could make an argument from a financial standpoint that, hey, if you want to be the reserve currency, you better be the military superpower. And that's an investment in that. Now, from what I understand, if you look at the U.S. Navy versus, say, the Chinese Navy now, that there could be, that might be up for debate. But in terms of our total spend, I don't think that there's anybody close to the United States at this point on military budgets.
And I'm not trying to make light of military actions per se. It's just the spending is I don't know. It just, that number being so large just always just makes me, I don't know.
Yeah.
It gets a chuckle out of me.
Yep. Well, we mentioned the big, beautiful bill, and we're trying to incorporate a little bit of, I guess, tax knowledge throughout this, show once a week. And, this was from First Trust, where they show the total adjusted gross federal income. So the share of income versus the share of those taxes paid. Now, this is another problem, because if you say like, if you say, well, let's just tax the rich, the problem with that is that even if you taxed every single thing that the rich make, it still would not solve the problem. So that's number one. It wouldn't even come close. But number two is that when you look at these charts, if you look at the top 1% of income earners, they're already paying, even though they're 22% of the income of the United States, so they're 22% of the income, but they pay 40% of the income taxes. So it's already hugely lopsided. Now, you should know too that investments and investment income is taxed differently than W-2 income. And if you are a high income W-2 type of person, that is a very, very bad place to be from a tax perspective, right? If there's investment gains, there's a lot of different ways that can be massaged, right, in businesses. So like, case in point, Warren Buffett, one of the most famous, richest people on the planet, he only pays himself, I think, $100,000 a year as his salary, right? As his W-2 salary. All the rest of his income comes from his company. And so therefore he famously says, look, I pay a lower rate than my secretary. And that's how, is because now in terms of total dollars, of course, he's paying more than the secretary, but by rate, we have a very high rate on income taxes relative to investment income. So The other thing is that the top 1% is already paying the highest average rate by quite a bit at 26.1 here. So, so sure, could we increase taxes on the rich? Yes. Is it going to solve the problem? No. We'd have to come up with some other solutions to the debt and deficits. Now, we titled this something along the lines of "Can't Stop, Won't Stop," right? And we're going to keep printing. I think we originally said like 1999. The thing I liked about that was, of course, party like it's 1999 for those of us that remember that time, but also a lot of the valuations in the stock market specifically are pretty 1999-esque, right? And, part of that, so if you look at this M2 money supply, this is kind of the most common way to look at how much money is being put into the system. Of course, first thing you'll notice is that the hockey sticks straight up in 2020 as a response to COVID. We started to taper that off, and the market really had a fit in 2022. And then late in 2023, they cranked the printers back up. And so that slowdown in M2 was in response to the wild inflation that we saw as a result of the increase in money supply and the decrease in supply of goods due to COVID. So those two things, you increase the amount of money people had, and you decrease the amount of stuff that they could get. So economics 101, the price goes straight up, and we got that inflation through the roof. So anyway, the printers are back on. So again, what doesn't change? And this has not changed. This started back at the end of 23, and it's continued. And so the money supply is back in full force and headed higher. Now, this quote I thought was really good from Warren Buffett in terms of there's just a lot going on right now, and a lot going on investment-wise, politically, et cetera, and it reminds you to remember the Buffett quote: "The most important quality for an investor is temperament, not intellect." And that is super true for all of us professionals alike, where you really have to learn to control your emotions as much as possible. And what's interesting about that is obviously people think about losing money and trying to control your emotions in the losing money phase. I would argue that the FOMO feeling can be just as bad or worse for people. People that tend to experience FOMO, the fear of missing out, if they see somebody getting wildly wealthy off of some obscure stock or even some well-known stock, it's extremely tempting for people to say, "Hey, that's what I want."
Right.
Forget about everything that I've heard about, prudent risk management. Let me just jump in and see if I can get rich quick too.
And some of this is also this is such an important thing that I've learned over the past couple of years, because prior to working in this industry, my impression was just that, you guys and a few others knew what was, quote, going on and was going to happen. And then there's people who just don't. But in fact, it's like more like you're willing to deal with the risk of even trying and continuing to try versus, either being so scared to not even get in the market because you don't want to lose a nickel, but you're losing one every single day because every day you're in cash, it's getting inflated away. And two, trying something, a couple of times, something you have no knowledge about, and then go, well, I'll never try it again. It's the temperament is a huge part of it.
Yeah, absolutely. And we constantly tell clients and prospects that look, a common misconception for people is that they think a financial advisor knows what's going to happen, and therefore, because they know what's going to happen, they can make the moves necessary ahead of time, right? And that is not the case for anybody. Obviously, if it was, and there's all kinds of famous, even if you knew what was going to happen, say you knew the outcome of something, the way that the market reacts can be completely the opposite of what you would expect. Right now is a perfect example in my mind where back in April, we had these tariffs come out. The market completely sells off, kind of panics, and kind of reacts the way you would expect it to. Now we basically have the same situation. Not a whole lot has changed to my knowledge. There's not that much different, but yet the market's like, we don't really care at this point. It's kind of like, show me you care. The market doesn't seem to care now. And so you can know the outcome, and you still won't know the outcome of how the market's going to react to it.
Which would be something like knowing the final score of a football game, and yet not knowing if you had placed a bet per se, not saying do that, but if you had placed a bet, knowing whether you were going to win that bet or not, even if you knew the final score, which would be crazy. But I mean, it's a little bit how quirky the market can be.
Yeah, absolutely. That's right. Now, we've got the sentiment indicators from AAII this week. We're, down just a little bit on the bullishness, uptick a little bit on the bearishness. This comes out every Thursday, but not anywhere near extremes like we saw back in April, or back in, I guess the 1-year bullish high would have been about this time last year, July 17th, 2024. I'm trying to remember what everybody was all excited about at that time. Dan, do you remember?
What of last year?
Yes.
It had to be NVIDIA.
July 17th of 24, our 1-year bullish high at 52.7.
I think that was NVIDIA mania. I think they were still cruising.
Yeah, that's probably it. Now, this week, the CNN Fear and Greed Index hit 76, which is considered extreme greed. Now, they have a dial there, or a little spectrum, and it's really just on the beginning of extreme greed. It's not deep into extreme greed. But nonetheless, take heed that we are seeing extreme greed on some of those positioning indicators there's 7 of them on the CNN Fear and Greed Index, and we've hit extreme greed there. Bitcoin was at 71 greed, which was down slightly from 73 of greed last week. Now, that was yesterday's number, given that Bitcoin ramped up to, I think, 118 just overnight, really. I bet if we looked at that again today, that would be deeper into the greed zone. Sentiment follows price. The higher price goes, people feel better about it. The lower it goes, they feel worse. So on this chart, Dan, I don't know if you're able to take that on the markets logo off for just a quick sec so you can see where it lands. This is the S&P 500 infotech sector. So this would be the tech. This would be just the technology sector of the S&P, which happens to take up about a third of the overall S&P index right now. It's very concentrated. We've seen that V-shaped recovery, and this is the forward price to earnings ratio. So what the market expects earnings to be, not what they are, but what the expected earnings are, and what the current price is versus those expected earnings. This is from Kevin Gordon at Schwab. Now, as you can see, over a long period of time, this is very high relative to history. And going back to your analogy on sports betting, and you could say this about horse betting or any other type of betting, you know that when you go to bet and the odds are, if you're going to bet on the favorite, your odds to get any money back really aren't that much, right? Because the expectation and the price is already there that the expected winner is going to win. And so if that outcome happens, there's not a lot of return on your bet, right? The only time that you get like a bigger return is when the unexpected happens, and you get an odds payout, right? And so the same thing happens with investing, where the market is pricing in growth, right? People say, well, AI is going to change everything. Okay, the market's already pricing that in. You can see it's basically the second highest level it's been in 20 some years at this point. So the market's already expecting you're going to get a great outcome, and that AI is going to change everything. It's already priced in. So if that doesn't happen, that's the unexpected outcome. That's where the problem would come in, right? Does that make any sense, Dan?
It does. Yeah. I mean, it's if you're buying something at the absolute peak price, hoping it'll go up even higher than that, and the odds of it doing that are high, but everybody knows that, so the payout would then be low. Is this, if you were to bet on the opposite, I mean, is this something you could short?
Yes, you can. Shorting is notoriously difficult, extremely risky. But yes, that's what, when you short something, you make money if it goes down in value. Now, this price elevation, right? Like if you would have started shorting back in 2020 when this price elevation initially happened, you would have gotten killed. So these things can be crazier and crazier. Remember, markets are made up of humans. We go through manic ups and downs, and so it would be an extremely dangerous proposition to do that.
Yeah, okay. I'm not saying they should. You were mentioning if it were to go down. I'm trying to think if someone's seeing this, what you would do about it if you like that.
Yeah.
What about here?
Okay, so it's July. Back in April, you remember what things felt like in April, Dan? It seems like it was...
Well, it was all over. In April, this time it was different, Chris. So it was the end of the stock market in April, which is weird because it's still here in July.
Yeah, and I got mixed feelings on this because on the one hand, I'm really glad that we got this recovery so quickly and that the pain was momentary in investing time. And thank goodness for all of us that happened. But on the other hand, we've had so many of these quick snapback recoveries lately that I fear people are getting trained like Pavlovian dogs that this is going to happen every time and that this is normal. If the market goes down, don't worry because it's going to be back within a month or two. And you can see out of these quickest recoveries, look, we've had 2019, 2020, and 2025. So 3 of the top 5 quickest recoveries in history have happened over the last 5 years, right? Now 98, interestingly enough, 98 was the year before 99 when the market hit its peak. I think it was in March of 2000. And then from that period for the next 10 years, the market was negative. So there was definitely not a snapback in that period. 91, of course, we got the 92 recession after that. But 3 of these fastest 5 recoveries have happened in the last 5 years. So you can't really hold it against investors to have this kind of training that, hey, buy the dip aggressively because don't worry, it's going to be fixed within a month or two. And I fear that people get kind of rocked to sleep with that false sense of security that, stocks, if they do go down, they'll be back within a couple of months.
And Chris, the 2 longest recoveries on this chart were at times the 2 times on this chart when money was being printed the least. Getting back to our theme for today's episode, I mean the amount of cash that's just we've shown it before, where you show the M2 money supply and then you show the S&P. We're at an all-time high. We're also funneling more cash in, more dollars into the system than ever before. And there's so many other things too with technology that just makes things faster and faster and faster that helps to, I think, fuel this. And could you imagine a 2, 3, 4 year down market? Could you really even fathom that at this point? Is that even possible ever again?
I definitely could fathom it. It's happened many, many times before in history.
But we're out of history now. We're into the future now. The history is way past.
Well, it's happening right now in bonds. It's happening right now in U.S. small stocks. It's happened in foreign stocks. It's basically happened to almost every asset class, real estate, U.S. real estate. The one that it hasn't happened to is the S&P 500, which is the one that everybody looks at, and it's the most popular girl, right? It's the most popular guy, and that's the one that everybody looks at. And so if that one hasn't done it, then everybody feels this, I think, a sense of security around it that it isn't like other asset classes, So now look at the dividend yield. First off, this chart goes back to 1786, and Dan, any chart that goes back that far is going to make it in. I wish the color scheme was a little bit better.
This might be the oldest chart you've ever shown, Chris. I mean, I know you've done Civil War, but we're right on Revolutionary War, buddy. This is very exciting.
Yeah, this is from Deutsche Bank via Lance Roberts. And they say, Deutsche Bank says the S&P 500 dividend yields are now within just 20 basis points, so 0.20%, of their all-time low. Last reached during the tech bubble, 1999. Prior to 1958, dividend yields were consistently higher than government bond yields. Equities were seen as inherently risky, lacking diversification, regulatory oversight, or corporate transparency. Investors demanded a high dividend yield as compensation. On top of that, dividend yields often enjoyed more favorable tax treatment than today, reinforcing the view that income was the most reliable path to long-term returns. But boy, have things changed now where people are willing to accept much, much lower expected returns in stocks in the future, given what they've seen and experienced in the past, especially in the most recent past. So this is just another measurement, another valuation measurement. We just showed the price to expected earnings on the Infotech side, and now we're looking at the overall dividend yield of the S&P, which is below the 10-year Treasury yield, which is kind of abnormal.
Wait, explain to me what the dividend yield is.
Okay, so dividends pay, a lot of companies in the S&P 500 pay a dividend that is paid usually quarterly. So if you think about it this way, let's say you owned a rental house, Dan, and sorry, clients are going to be like, I've heard this one before. say you own a rental house, okay? Now, on that rental house, you're going to have two sources of appreciation, at least two that are readily apparent. One is hopefully that house goes up in value over time. That's your principal, right? But also in the meantime, you're going to be receiving dividend payments or rent every month from your renter, right? So just like a rental house, a stock, hopefully you're going to get principal appreciation over time. But in the meantime, they're also going to pay out a portion of their earnings to you, the investor, as a dividend. And that percentage that they do that is called the dividend yield. So some stocks, you think like some of the most famous ones would be like Procter and Gamble. They've been paying a dividend for forever, and they increase it every year, almost, no guarantees, of course, but that's what they've done historically. So a lot of people buy those for the predictable income of dividends, as an example.
Okay, that's exactly what I thought it was. So you're telling me back to the last slide that at least for tech stocks, we're paying some of the highest prices we've ever paid, and then they're paying back some of the lowest dividends they've ever paid, and or none at all.
Correct. And similar to the real estate market right now, anybody that's trying to buy, say, residential investment real estate, especially in California, you look at it and you go, there's no way I can cash flow this. I can't go get a 6.5% or 7% mortgage, rent it out, and come close to covering my expenses, right? You buy those investment properties just hoping and praying that the principal is going to go up over time. Now, people that have owned them since the 70s and the 80s and the whatever, they're fine because their house is usually paid off. And, if the rent's low, it's not that big a deal to them because they've got such a low basis in that property. But if you're going in fresh and new, those prices on real estate are so elevated that it makes it really difficult to make any kind of current yield on them. Now, we might be witnessing a changing of the guard in the leaders within the S&P. This is the S&P 500 versus the S&P 493 versus the Mag 7. So basically trying to isolate the performance of the Mag 7, which I've actually heard some people say the Lag 7 this year in a derogatory way, right? Because if you look at so far this year, the Mag 7 up about 3.6 versus the S&P 493, so kind of the other stocks up 8.42. And the overall S&P is up 6.78 as of when this chart was created. This is looks like the 10th of July. So so that concentration that we've seen over the last few years and those handful of stocks that had done so well are lagging this year. And specifically, you know, Apple is really struggling. That's probably, I would say, the most like owned stock of, you know, widows and orphans and everybody else, right? You know, they used to have those, right? Where it's like, okay, everybody owns IBM or GE or whatever the quote unquote like GM back in the day, right? You know, people would look at it and go, there's no way you can lose. You just buy it and hold it forever.
Not going
Apple,
anywhere.
Yeah. We use their products every day. Apple's that stock of our time, I feel. And it's really struggled this year. And of course, Tesla as well. Both of those in the Mag 7 struggling. Meanwhile, Nvidia, you know, passed 4 trillion this last week. First stock to hit 4 trillion. So Nvidia's got its mojo back and continues to chug away. So last kind of thing on the valuations of the S&P 500. This is from Bank of America, global research showing the equity risk premium. Now, the equity risk premium is just like it sounds, the extra amount that you should receive or approximate amount. This isn't like something you can calculate down to the penny. But the approximate amount that you get paid to take on the risk of owning a stock versus just owning a 10-year treasury. So you could take your money and you could go buy a 10-year treasury, and the government will pay you back over time. Hopefully, they always have before, right? Right. Or you can take that money and put it into stocks. Well, what's the extra amount that you're getting paid to take on that extra risk? And right now, that equity risk premium is not quite as low as what they calculated during the tech bubble in '99, but we're getting down there. Now, you'll note in 2000, the equity risk premium got below zero, meaning that at that time, it was projected if you purchased the U.S. stock market, your return over the next 10 years was likely to be zero. You were likely to get a zero risk premium. And it turns out that that's what happened over the next 10 years. Had you purchased in early 2000, is you actually had a negative return over that time period. So these things can go on for a while. I'm not saying that this is the end. All I'm saying is that the U.S. stock market is priced pretty richly at the moment relative to where it's been. And again, we've been saying this for a few years, but I'm just wanting investors to remain a little bit wide-eyed going into this, because we're noticing more and more people just saying, "Hey, just put my money in the S&P. It's the safest place to be." Right? And that's like, whoa, pump the brakes here.
Right. And just if you're of age, remember 2008. Remember a time. I'm not saying that now is then, but remember there was a time in your life when it terrified you. And remember that it does have teeth. That you feel so good about it right now. Just back in April, you felt maybe not so good about it, even. Right. Just looking much sooner back to April. So back to that Buffett slide, temperament, you know. Don't just sit there and just ride waves. Oh, everything's seeming great. All right, let's do it all. And everything's seeming bad. Oh, it's the end of the world. You know, it's about finding that middle ground, that kind of, I call it surfing, where you're just like, you're able to see the waves and roll with them, and you're not getting too jacked on one and you're not getting too bummed on another.
Absolutely. Go back to that slide for just 1 second so I can beat this dead horse a little bit
One
longer.
more time. Bam!
If you look at another extreme, look at 1980-ish, 82. Okay, that's widely regarded as kind of the beginning of the modern bull market. Was 1982. Now that was right after the 70s, one of the worst possible times to be an investor in any way, but especially an equity investor. Was during the 70s. And so it came into the early 80s and 82. The US stock market's price to earnings ratio was sub 10. It was dirt cheap, right? And we just come off an entire decade of stocks really just struggling, and nobody wanted to be in US stocks. And if you look at the equity risk premium at that time, up at 15%, that's where it's saying, hey, the payoff odds are high, right? Relative to history, the payoff odds are high. And so this isn't a timing tool, especially in our modern age where we just care about the next couple of months. We're not looking at years at a time, because honestly, these distortions in the market can happen and last for 2, 3, 4, 5 years, which in our modern measurement of time is forever. So anyway, okay, so a lot of talk about interest rates. Where should interest rates be? Um, and should they be lowered? Should they not? Well, I mean, you've got stocks at all-time high. You've got Bitcoin at all-time highs, gold at all-time highs, home prices at all-time highs. Um, I think it's kind of hard to argue from a standpoint of the markets that rates should be lower. But let's look and see what the rates market is saying. That the 2-year yield, which is widely regarded as the short-term the short-term expectations of the market in terms of where short-term rates should be. We're at 3.86 versus the Fed's current rate at 4.5. So there's a little spread there, but nothing crazy. And if we extended this out, you would see that the Fed is tight relative to the market. But that spread between those two is not, it's not at an extreme where it's like, oh my goodness, how could this be any more obvious on what needs to be done in the rates market? How can they not heed the advice of the market at this point? They're so tight relative to expectations. It's unbelievable that they're not lowering them. It's not anything like that, in my opinion. So a lot of drama in the markets in terms of what's going on between President Trump and Chairman Powell. But in terms of what the actual rates market should be, I think the market is saying, we're in the ballpark. So we've been talking about the opportunity in foreign stocks, how they are relative to U.S. stocks, some of the cheapest that they've been in a long time. And what you're starting to see is more shareholder-friendly behavior, buybacks specifically. What's a buyback? That's when a company starts to buy back their equity. So it's shrinking the number of shares. I've heard investors call it cannibalism of stocks. They're looking for the stock cannibals, because by doing that, you're returning funds to shareholders. It's one way of doing so, and it's a more tax efficient way, has been historically a more tax efficient way to do so than paying a dividend. And so companies with high share buybacks tend to do well over time. Buffett is the most famous for hunting down share buybacks, and you can see the UK is starting to see some elevation there. In Japan, there's been a lot of shareholder-friendly moves in Japan here recently, and that's probably helping to feed what we've seen in the foreign markets relative to the U.S. this year.
So if I owned stock in a company in Japan and they do a buyback and I'm still holding the stock, by having less shares, that means what for me?
You get more of the future returns, right? So think about it. It might be helpful to think about it in the opposite way. Um, if you own a company and they issue more shares, um, then uh, then you get less of those future earnings. So if you and I owned a company together, and we're just splitting those earnings, the two of us, and so and then we issue shares and bring in a third partner, then you and I are going to take less of the earnings, right?
So when the company does the buyback, the shares that I'm holding become more valuable, yes, because there's fewer of them?
They should. Now it's up to the market, right? It's up to the market, but you are, by shrinking that share count, you're increasing the returns on equity over time, which should return capital to shareholders.
Is a buyback the opposite of a split?
Yes. No. A buyback is the opposite of share issuance, dilution.
Okay.
Commonly called dilution. So think if you get diluted, that's not a good thing, right?
Right.
Just like if we're, let's say we're splitting some wine, right? We're in wine country. We're having a nice bottle of wine, and suddenly we dilute it
Right.
with a little water.
We've got more wine.
We got more.
We made more. It's a blend now.
Yeah. A whole bunch of people are home. We're going, oh, okay, I got you now. Now I understand. Right. Or those of us who grew up in those households with soap, and this still happens in my household.
Oh, for sure.
Run out of soap, and all of a sudden
End of the soap.
hit the squirter, and it's like way more liquid, right? Suddenly you had more soap somehow.
Yeah.
But it's a little different consistency. Okay, so this one's for our friend Darren. We've got the IBIT Bitcoin ETF, and how long it took to cross $80 billion. And look at that versus VOO, which is the S&P 500, the IEFA, which is the developed markets, and the IEMG, which is the emerging markets from iShares, BlackRock, as it's otherwise known. And look at that. The number of days is just, I mean, it's amazing what Bitcoin has done. There's no way to get around it. I mean, this is from Eric Balchunas, and he says, IBIT blew through the 80 billion mark last night, fastest ETF to get there, 374 days. So just a little over a year, about 5 times faster than the previous record held by VOO, which did it in 1,814 days. Also, at 83 billion, it's now the 21st biggest ETF overall. And so it's really, I don't know how you say that Bitcoin is not one of the, asset class, legitimate asset investment class now. I mean, it's been accepted. It's accepted by the man. It's accepted by the public. It's accepted by everybody. We're here. So wanted to kind of end that slideshow with these words from Howard Marks, and I've heard something similar from Corey Hofstein at Newfound Research. I thought it was so great because the quote is, "Risk cannot be eliminated; it just gets transferred and spread." Right. And it's similar to the laws of physics with energy. Energy doesn't get eliminated. It just gets morphed into different areas. Right. Risk is the exact same way. Risk is always going to be a factor, and always has been, and it always will be. It morphs into different areas. A lot of times we have a really difficult time understanding where it is. And that's because life is unpredictable. Just like the weather, sometimes things only happen every 100 years, and we as humans are not very good at being prepared for those types of things, because we're a recency bias machine, and so we have to constantly fight against ourselves to prepare for things that could happen, not likely, but could happen at any time. And by the time you need a friend, it's too late to make one, right? So you got to be prepared for these things ahead of time, or suffer the consequences. Okay, so let's go through the different asset classes here real quick. We start out with the S&P 500. We've got the simple moving averages. What you're looking at here in orange is the 200-day simple moving average, which is kind of the longer term one. The shorter term one is the 50-day simple moving average. And the upshot of this is it's just there to help you understand if there's a trend in one direction or the other. And we've seen the golden cross, as it's called, when you get the 50-day going above the 200-day in the upward direction, like we just saw here in July. That is called the golden cross, and that's because it's shifting from a sideways or a downward trend into an uptrend based on those moving averages. So that's a good sign that we're seeing at the moment.
I got to go back to April, because April we had a quote death cross, and that's where the 50 goes below the 200.
Correct.
I don't know who is coming up with these phrases, but a death cross means that it's going towards something where there's a death and it ends. So, hey guys, there's a perfect example of how wording and phrasing can affect your temperament. If you're an investor in April and you hear death cross, you see that headline. It's like S&P crosses death cross mark. Just like... And there's that photo of the trader with his head in his hands. You're like, it's over. Whoops. It's actually a golden cross in July. So we're all good, guys.
Yeah, absolutely. These things can and do change quickly. Now we've got the EFA index, which is the developed, quote unquote, developed markets, stock markets, also looking very healthy. We've got the upward trend is definitely in place. We've seen a little bit of a correction since mid-June, but in terms of the overall trend, we're still in the upward direction, and the trend continues today. So the other thing that's kind of interesting with these moving averages is how the market kind of tends to return to them from time to time, make changes around them from time to time. The kind of pattern recognition of the market is really it's kind of amazing. So it's not surprising to see the index kind of come in and check in with that 50-day moving average. A lot of times you get a little nervous when you see the index get far away from the 50-day moving average on the upside, because it gets a little stretched, a little overbought, and a lot of times it will return back, to check in with those moving averages. All right, and we got emerging markets, not quite as strong of an uptrend as what you see in the developed markets for sure, but nonetheless in an uptrend. Still the second best performing stock market, like large index, I would say, is the emerging markets behind the developed markets this year. That is still intact. So an upward trend there as well, still looking pretty healthy so far this year. And then we've got the long-term Treasury bonds, which are still, I would say kind of sideways, right? And there's been a lot of conversations about these, and that's going to continue, as a reflection of U.S. government policy. At least that's the narrative around it, right? But if you kind of didn't pay attention all year and you just checked the price at the beginning of the year, checked it at where we're at now, you'd say, oh, not really much has happened along the way. So sideways trend in the long term bond markets. Then we've got the Agg, lovingly referred to as the Agg, the Aggregate Bond Index, which is kind of the shorter term, 7 to 10 years on these bonds. This is the more widely owned index, I would say, or at least more widely benchmarked for most investors, is the 7 to 10 year. And again, you're seeing just a sideways market, which, hey, for bond investors, they'll take it, right? After the last 3 years where it feels like the bond market just got bombed, having a year where we've just gone sideways probably feels pretty refreshing at this point. So, but we've just got kind of sideways movement, which means that the bond investors are just getting their coupons, and that's the return of the bond market. Kind of same old boring return profile that you would expect from the bond market at this point. Then we've got gold. Gold, the best performer. Well, I don't know. Bitcoin might be beating it now. I'd have to double check. I'm sure Darren will jump on and let us know. But the gold shares have done extremely well this year, and boy, that trend looks pretty strong. Each time the gold market has come in to check in, it's really taken off again. Now we are seeing, like, look, we've crossed that 50-day moving average a few times since mid-June. So maybe we're starting to see a little stall speed in gold. Would not be surprising at all, given the strength that we've seen over the last really 5 years in gold, but especially over the last year or two. Would not be surprising at all to see gold pull back a little bit and return to the mean. But right now, the trend is up. The trend is very strong. Then we've got Bitcoin. Same thing there. We started to see the trend sort of turning down, and then May, that's taken off again. And just over the last few days, we really saw an up ramp. And anybody that's been watching Bitcoin for any period of time knows that the moves come quickly, and so it'll move sideways for a while, and then boom, you wake up the next day and you're like, wait a second. Are my eyes fuzzy, or is that 118,000? Like, what am I looking at? Right. And that's exactly what happened this morning for me. So, Bitcoin, you better be ready for action. There's almost always action in the Bitcoin markets. Commodities, sideways. So look at this trend. Now, commodities are a lot noisier. The volatility, as you can see, is a lot more. We got tariffs announced on copper this week, and copper jumped 8, 9, 10% in one day. Again, market doesn't seem to care. I don't know how that's possible, but somehow the market doesn't seem to care about the cost of copper, the supplies of copper. But we are sideways in the commodities index, which, so not a whole lot of information there. But in terms of inflation expectations, a lot of times you start to see commodities go up when inflation is expected to go up, and or when growth is expected to go up, when people are going to be using a lot of commodities to make things in the economy. And as of right now, we're kind of sideways there in terms of trends. And the last one sideways here is the U.S. real estate market. Now, this is investment real estate. So think offices, think apartment complexes, those types of things. Investable real estate, not residential real estate. And this has been sideways year to date. And, if you extended this out, it's been sideways really for about the last 4 years. Now, it's been up and down over that time period. But in terms of, if you just purchased this for, say, 4 years ago and came back today, it's roughly right in the same range. And so we've had a lot of sideways action in real estate as an asset class as well. So that's where we'll end it this week, Dano, in terms of the charts. Hopefully that was helpful, and we covered everything in terms of where we're at today.
Chris, what would happen if the government stopped printing money?
It would be probably pretty bad, right? Deflation is when you get into the opposite of inflation. That's when prices start to collapse. Now, deflationary spirals, like what we saw in the Great Depression, and also we saw in 2008, only to a lot lesser extent, are awful for everyone. And just like inflation, once it gets kicked in, it's really difficult to arrest the dominoes that get triggered and start falling. So it's a tricky thing with the money supply in terms of you looking for that Goldilocks scenario. You don't want to run it too hot. You don't want to run it too cold. It's got to be kind of just right in order to keep things tuned the way they should be.
And based on the money supply chart that we showed earlier, do you feel like it's too hot right now? I mean, they've clearly turned it back on, and oh, by the way, market's back up to all-time highs.
I think the Fed has to look at what's going on in the economy, less so what's happening in the markets. Now that's kind of hint, wink, wink, because we all know that when the markets come apart, at least recently, the Fed has stepped in and made their presence known. But outside of that, they should be focused on employment and stable prices. And if you look at those two metrics, things are pretty copacetic right now. The unemployment rate is low and inflation is pretty close to their 2% target. And so I think that, they got their soft landing that they were looking for. They did let the inflation get ahead of them. But they also they got that soft landing as well. And so when you look at just where we're at in terms of employment and inflation, it seems like they're tuned pretty well at the moment.
We'll leave it there. Chris, thanks so much for a great show this week. Thank you for listening, checking out the show, watching the show, wherever you found it. Just so you know, wherever you are right now, YouTube, Apple, Spotify, we would love a subscribe. That definitely helps the show. That helps us, or a like if you can. And thank you so much for listening. We are Sonoma Wealth Advisors. You can learn more about us at sonomawealth.com. And we will see you back next week right here on The Markets.